Brian, I'm excited for this. I always love our chats. So first, thank you so much for joining me once again today, Brian.
No problem, Harry.
Listen, I want to start, for those that maybe missed our first show, just with some context. How did you make your way into the world of venture, and how did you come to be a GP at Founders Fund in a short 1 to 2 minutes?
Man, it's been a long time now. I started at Founders Fund almost 15 years ago. I was at Google. I was an engineer and an engineering manager, and started doing startup investing on the side there in 2006, 2007, investing in a whole bunch of Y Combinator companies when Y Combinator was still brand new. Decided to make that my full-time thing in '07. Was trying to figure out what to do. Do I raise my own fund? Do I do something else? And that's when I met Sean Parker, and we became friends. And he said, "Hey, why don't you check out what we're doing at Founders Fund?" And I came in, and that's when we were considering a little investment in a company called SpaceX, and said, "This is what I want to do." So I joined up.
I love that. And one entry point with the SpaceX investment. I want to dive straight in on investing mechanics, to be quite honest, Brian. I had Keith on the show not too long ago, and he vigorously kind of debated or disagreed with an idea, which is buy low, sell high. I often get it now from LPs, and they say, this is the time, Harry, where you can buy low and sell high. Do you agree with that principle? And can you give me an example of either way where it's worked for you?
Yeah, I don't know. Venture to me is just very different from normal investing. I don't claim to know anything about macroeconomics, and I don't follow it all that much. At the end of the day, venture is a game where you make an investment and you're not going to see any payoff from it for, a decade, right? And so that's going to span a whole bunch of different macro economies. So this concept of buy low, sell high, like using regular stock market phrases in venture, to me just doesn't make any sense. You have to invest. You have to just invest in really good companies. Now, you can't pay ridiculous prices because that limits your upside, right? So venture capital is a game of upside maximization, and the higher price you pay for something, that's going to limit your upside potential on that. So you can't just go and invest at ridiculous price, ridiculous end of 2021 prices in things. However, either the company is going to do really, really well over time, in which case you'll be able to sell it high or sell it higher, or it won't, in which case it won't matter to you at all.
Do you agree with the thesis or notion that early stage investors, because of by very nature of liquidity being 10 years out and the long nature of our business, that we don't need to pay attention to macroeconomics and macro markets because it is so far away from where we are in the insertion point?
No, I think it's good to pay attention to it because for instance, right now we're at a point in time, and we're talking in September 2022. I guess October 2022. You can edit that. And there's such a huge price mismatch between, let's say, a company's last round of financing and what the macro is, that it's really difficult to invest right now, simply because private companies lag public markets in terms of pricing by quite a bit. Because private companies don't have a new price associated with their companies unless they raise another round of financing, many great companies are opting to just not raise money now and try to ride it out, right? And so I don't think it makes any sense to not pay attention to macro. You have to pay attention to it. I just don't believe anybody can actually predict it, right? My partner, Peter Thiel, is brilliant macroeconomist and probably the best in the business at this, and he can't even predict this, right? Like, predicting macro is extremely hard. So I think you pay attention to it. I think you let it impact your investing, but I don't think you try and predict it or sweat it too much because there's nothing you can do.
In terms of where we go from here, I see this like 3 stages, which is like structured rounds coming now, increased lick prefs, you name it, and then down rounds and then recaps. Would you agree with that kind of stage of process of how we're going to see this shake into the ecosystem?
Sure. I mean, you're already seeing a whole bunch of companies go out of business, or companies trying to just raise bridges to get them through this, or the best companies just simply say, like, yeah, we can let some people go and ride this out, or not even, some of the best companies don't even have to let people go, and just ride it out, right? And so it's tough to do a deal in this climate, because you don't want to just be doing these deals, like doing recaps while theoretically playing into your buy low, sell high. It does have a lot of negative impact on companies, right? And so sometimes they just can't ever get out of that. And again, with venture being about upside maximization, are you really just looking for like a good deal, or do you just want to invest in the best companies? And I would argue it's all the latter.
So I totally agree with you. And you saying about kind of it's hard just to get a deal done, is that not a prime opportunity for someone like Founders Fund, in the notion of, be greedy when others are fearful, and keeping that in mind?
It depends. I mean, if you find one of the best, we only want to invest in the best companies, right? And so if one of the best companies, if we see something as the best company, that's an amazing company, and we can actually get a reasonable price on it, absolutely, we're going to invest. But if even the best companies want, end of 2021, beginning of 2022 prices, where other comps in their market have gone down by 80%, then we're also just not going to play that game. Like, we don't have any pressure to invest capital. We've done very well by our LPs. They trust us with their money, and we feel zero pressure to invest capital. We can just wait. And there's always going to be, hopefully, right, in the world, there's always going to be really, really, really good companies, regardless of the macro cycle. And so we can just wait until prices actually catch up, and then we can invest in great companies at great prices.
Can I ask, when you look back at 21 and 20, on reflection, do you think you deployed too fast?
Yes. In 21, that said, we had our best year ever in 2021, right? Just because we kind of got, our strategy has always been to distribute shares / capital right when we can in companies, simply because we don't think we know the public markets better than anybody else. What we do better than anybody else is private company investments. And so why would I do anything else? And so, you had to make decisions in 2021 on whether you had a bunch of companies go public. It was kind of a crazy year for venture capital, and you had to make a decision on whether you held those or distributed. And we've just always had a history of distributing these shares at lockup, just because, we don't know more about public company investing than anybody else. And so we tend to not hold those.
If you think about the last few years, I have two big lessons. One is, bluntly, I should have been more strategic about taking cash off the table. And two, I think I should have been less focused on what the next round investor would want, because you can't predict how that changes over time, as it has done recently. Are there any kind of lessons or key observations you're telling the team, younger ones in the team, that you think through from the last few years?
Sure. I mean, for me, we've had so many discussions about this and about what the last couple of years means, and did we go too fast in 2021? And of course we did, but you can always predict the past and predicting the future is much harder. And to me, I've never been able to be convinced that we should be doing anything other than investing in the best founders or best companies possible at the best prices possible. I don't really know what we could have done, what to do differently. And right now, I've personally slowed down investing a ton simply because you cannot get a good price on the best companies. Okay, so I'll slow down. But I don't know any other way of doing venture capital. And regardless of any lessons or anything else, I have not found anybody who can change my mind that this is just about investing in the best companies possible, or putting the most money into the best companies possible at the best price possible.
The weird thing I find is I'm almost, especially at the early stage, seeing this price inversion element, where you see the migration of later stage capital down earlier and earlier stage. And so actually, for obviously the best pedigreed founders, the price is actually higher than ever, because you've got an increased supply of capital going in. I think we're going to see that for your... How do you think about that then?
I mean, it's why we haven't deployed much capital in the last 6 months. We deployed one. My typical strategy is to try and deploy just a huge check. into the best companies. And we did a $200 million check this year into Anduril, right? And that for us is like, yes, no brainer to plow a large check into at this time. But there's been nothing else. Even though I've seen great companies, we just can't they're not interested in raising at, October 2022 prices, right? And so I would love to invest in them, and we'll see. There's probably going to be some that it'll be like, all right, we get it. We'll raise a little more capital right now. We won't raise a lot more capital because we don't want to take that dilution, but we'll raise a little bit more capital now just to, shore up the balance sheet and do it at a reasonable price. And those we're going to be all over. But so far in 2022, the only big check I've done is Anduril.
Can I ask, if you were to draw up a list of like 1, 2, 3 names of companies that you would love to deploy capital to, but haven't, which would those be?
No, I'm not gonna do that because I'm actively trying to do this right now, and I don't want to. Yeah.
I literally had this conversation.
But I will say that yes, there are actively companies that I'm trying to deploy a large amount of capital to. It's always just a matter of, can you come to the right terms with the team?
How do you advise your founders today? When you're worried about
in which case, like, for founders that are, profitable, I mean,
founders that are saying, hey, fundraising markets have changed. We've got 18 months left. Is it going to get better? Is it going to get worse? Should we raise more?
As you can probably, my answer is I do not know. I don't try and predict macro economy, period. I don't. I only play games that I know that I can win at, right? This is why I don't do public. I don't buy any public stocks ever, right? Like, and I don't try and predict, be one of those VCs who sits there and like says, oh, the funding environment's going to be bad for a long time, or it's going to get better. Like, who knows? Nobody knows. And so you only do what you can for right now, and you assume that right now is how it's going to be. And so if you're a company that needs to raise some money, like, I advise doing it at a reasonable price that doesn't kill the company, or some companies are going to have to shut down. This is just the reality of this business. Is you get into these cycles, and I've seen this before. I've been doing this for a long time, where a lot of companies are just going to shut down, and that just is how it is.
Brian, do you know what I love? You're so different to every other VC with the pontifications and the.
I don't pontificate. I invest. Here's what I do. I invest in. I have what I think is a pretty good knack of picking the best founders, doing things that have a potential to be very outsized, and I have no fear of backing in the truck and plowing a whole bunch of money into those companies. That's what I do. I don't sit here and try and tell you about macro. I don't know how to run a company, right? Like, that's not what I do either. I would be a terrible CEO. All I can do is spot really good founders in outsized markets doing things that have true moats, and I'm pretty good at that.
So I lost money for the first time earlier this year, and my takeaway was actually that no matter how world-class the founder, no matter how brilliant the team is, if they're in a market which is just inherently fucked, challenging, vulnerable, no team can get out of it if it's sometimes so hard.
Sure, that happens.
How much does market play a role in your mindset then, given your ability and knack to pick founders?
Oh, pretty good. A lot. I mean, you've got to be. If you have a really, really, really good company in a tiny market, it's still not going to move the needle on a multi-billion-dollar venture fund, right? It's got to be both. It's got to be really, really good company in really big market to move the needle on funds of these size. And so, thinking through the market and thinking through that definitely plays some role. I mean, founder quality is still 80 to 90% of my investment thesis, right?
Would you say that Airbnb was a big market?
Of course. Are they like early stages? Of course. If you could see that this was like taking over in terms of like how people were thinking about staying at hotels versus staying somewhere else, especially we had a huge advantage living in San Francisco at the time because the hotels here are just like terrible, and the hotels are in such terrible locations in San Francisco. I don't even know how people come visit San Francisco, right? Like, the hotels are just in such terrible locations that you just have to stay in an Airbnb here because You don't want to stay downtown San Francisco.
I remember once staying at the Cliff, and I was like, "Oh,
Yeah,
this is
yeah,
nasty."
no, it's just like it's and so no, we definitely saw at the time that the network effect on Airbnb was at the time was huge, and yeah, the market was it was clear that they could penetrate into the travel market or even the lodging market, which I guarantee you, Harry, is huge.
That I totally get. Do you think your winners are obvious early?
Oh, it depends on which stage we invest in. Like, do I think our winners are obvious at the seed stage? No. Do I think that do we play on a better dartboard than most people because we can see founder quality better and get into those deals with the best founders? Yeah. I think they're pretty good, but no, I don't think anybody can see that something is going to be, or they can say they've got their thesis and whatever. But like, I don't think you can predict $100 billion companies at the seed stage. That's silly. But you can predict, hey, this company has a way, 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 way better shot at being a big company than most. And that's what you're doing at the early stage.
You said about kind of loving to do the larger checks, kind of one a year, say your $200 million check, like you mentioned earlier. In terms of like reserves, does that mean you kind of put the check in and that's your position?
Oh, I never think about I don't think about reserves ever. Period. Like I literally never think a second about reserves. Like, if we are good investors, we raise another fund, which we've done, and there's no reason the best companies can't go across multiple funds. I don't think any of our LPs are upset that there's multiple rounds of SpaceX in multiple different funds, right? Like we've always.
How do you respond to LPs? We both know LPs when they say, "No, I don't like cross-fund investing."
You don't have to invest in Founders Fund. Again, we're in a good position. Again, success breeds success, and we're in an unfair advantage here. But this is why you have to take advantage of unfair advantages, right? Like in that we've been so successful at cross fund investing, and we've done everybody so well, ourselves, our LPs, and everybody else, that we've got a broad latitude to do this, just because we've historically just like made a ton of money for people by cross fund investing. So why wouldn't LPs want to make money?
So I think success in venture is like cyclical and self-fulfilling. I said this to Doug at Sequoia, and he was like, no. People don't just come to me and say, hey, take your best company from me. Like, it does not get easier with more success necessarily.
Certain things do and certain things don't, right?
What does and what doesn't?
When you've made money for people, you have a lot more latitude on how you can invest money. So you've got the freedom to do whatever you want without people breathing down your neck. Now, does it get easier to invest in the best companies? Well, sometimes yes, sometimes no, right? Success breeds good brand. And, if venture capital is, do you see the right deals? Can you pick the right deals? Can you get into the right deals? Right? The getting in part has a huge amount to do with brand. And founders want to be associated with winners. And so that part does breed success. Now, does it help with the seeing stuff? No. And that's why I'm always so obsessed with, are we seeing, the right companies? Like, brand can be noise and detrimental for the seeing part, for the diligence, for the seeing companies part, but for the sourcing. But I'm obsessed with making sure that we've got, a broad range of people sending us deals.
I totally agree. If you go one level beyond the seeing, people often are quite binary around, it's a picking game, and no, the best deals are the picked ones.
Oh, no, I don't know which, the seeing, picking, and getting in part are equally as important to me. You have to be top level. The best firms all know this. Like, you have to be top tier at all three of those things. And, even if you can pick, good luck winning a deal over us or whatever, if we're there at the same time, right? Like, you've got to be top tier at seeing, picking, and getting in. They're all equally as important. And the part that's just harder and harder over the years as you do this longer and, quite frankly, get older, is the seeing. You've got to keep your networks fresh. You've got to make sure that you're somehow still connected, right? Because your networks get stale, and we know that. Adapt or die in this game, right? Like, you can't just rely on the PayPal mafia forever. You've got to just, keep adapting. And so keeping our networks fresh, interesting ways of doing sourcing I'm obsessed with that stuff. I think we're pretty good at, we're fine at picking. And I think success breeds even more success at the getting in. But the seeing part is just really hard.
Can I ask, when you sit around the table with other partners today, it's lunchtime at Founders Fund, and you're saying, this is our main challenge. This is our main challenge.
Sourcing.
What do you think? Sourcing.
Well, right now it's a little bit different. Our main challenge right now is there's just a huge price mismatch between the public and private markets, and so I'm saying, like, there's not much you can do about that. But and I don't think we can. There's not much we can control about that, right? Because that's a lot macro related, and I never try and control macro. Yeah. Of the part that we can control, and this is literally what I obsess about at the lunch table, is the sourcing part. Like, how are we keeping good? How are we making sure that we at least talk to founders of awesome companies that are out there?
Where does that conversation go? Like, you see other funds, creating products like accelerators, incubators, scout networks. Where does your conversation go?
I mean, look, we've done that too. I mean, I don't think that goes to any one strategy, right? The way that we do things at Founders Fund is everybody runs their own strategy based on what they are the best at. I don't know how to run a company, so I'm not going to go start a company. But Trey is excellent at starting companies. Keith is excellent at starting companies. So great. So Trey and Keith go and start companies, right? And yeah, hopefully one of the reasons they do that is to have an awesome company, and both, Anduril and OpenStore are fantastic, right? But another reason is to keep their networks fresh, and because they were going to have a lot of people working for them that are eventually going to go start companies, and hopefully you get an Anduril mafia and an OpenStore mafia or whatever, right? Like, absolutely, that's part of it.
Can I ask, I was listening to a podcast the other night about Benchmark's journey, and they were talking about actually a really challenged time for Benchmark, and I can't remember when it was exactly. I was just kind of like, in my head and from the outside, Founders Fund has just been this continuous progression of success. I'm sure internally there are moments when there's like a year or two where it's actually harder. Can you take me to one of those years or two, and why?
Well, I don't know. I mean, I think one of the reasons that we're successful is that we, as a firm, we have no dogmas, or we try and have no dogma, or try and have no, this is how you do it. Honestly, I think we are just better at adapt or die than other people. Like, we're better at realizing that even the things we said last year, or the things, honestly, that I'm saying on this show, they might be total bullshit, right? Like, you have to change it. Right? If the world changes, you change. And we're really, 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 really good at not having specific set views that are set in stone here. Which is why, one of the things I think we've done really, really well is our hiring. We've been able to focus our hiring on people that come in that have a unique, truly unique angle, or moat, if you will, that makes them specifically special, whether it's in the sourcing, picking, connections, getting in, anything, right? If it's a unique strategy that is differentiated from the current partners that are here, we are interested in hiring that person. And that's really paid off. Like, our focus on not hiring clones, our focus on not hiring just people who are generically good, our focus on just hiring people who have unique strategies and strengths that can pay off is what we've been really good at. We just hired Sam. Our newest partner, Sam Lon, right? Like, this Sam has a phenomenal, unique story. Like, usually when I'm in these interviews and I'm interviewing candidates, and I specifically say, I'm like, okay, what is the thing that you're better at than anybody else? And I don't care what that is. I just want somebody to have something, right? Sam's answer is just phenomenal. There's not many people who understand high growth tech and actual, sales and enterprise sales and high growth tech better than Sam. And that's just, it is what it is. And so he has such a unique skill set that most people don't have that it made him a no-brainer to hire. And to answer your question of why we've been successful, throughout our, approaching 2 decades now of existence, is that. It's being able to see, just like we can see unique moats in companies, we see unique moats in people. and just hire those people.
Can I ask, with traditional firms, when they bring in partners like Sam, they have a lot of structure around them, a lot of mentorship, they kind of sit with you in boards, and they kind of learn craft of venture beside you. Founders funds obviously a lot less structured than like traditional firms. How do you think about providing those same kind of positive educational guardrails to someone like Sam?
Oh, me and Sam strategize all the time. Like, I could never do what Sam does, right? So I don't try and like tell him, oh, here's how you should do this. But we strategize about angles that he could be playing in order to see, pick, and get into the best deals all the time. And those are some of our most fun conversations when we're just like strategizing about how to leverage his strengths, which he is the best in the world at understanding actual sales of high growth tech companies. And again, for founders listening, like, they know this, right? He is a guy that you want to talk to because nobody knows this better than him. And he needs to then leverage that into seeing the best high growth, companies that can utilize his skills and then grow into other things from there. Remember, I'm a gamer, true and true, right? Like I just focus on what are my strengths, what are my, the current things that I have that nobody else has. How do I exploit those? How do I leverage those in a way that nobody else can catch up with? And that's what I talk about with Sam all the time, too.
Brian, do you think boards add value?
I can't stand boards. Private company boards, like, I would much rather do strategy dinners with founders, and they know that. My strengths is not corporate governance or financials, or I'm really bad at that kind of stuff, Harry. Like, I it just is what it is. I'm not good at corporate governance and financials. I am pretty good at strategy. And so the founders that want to work with me are typically the ones who, like, instead of needing to have me in a boardroom where I don't, it's not my strength, right? They would rather just be like, oh, hey, every month, every other month, we're going to grab dinner and strategize. I'm like, great. That's the part of this job that I love. Like, we've been pretty successful, and after doing this for 15 years, you start to think like, okay, well, what am I doing this for? And the main reason, the thing that I love about this job still is strategy dinners with top founders.
What makes the best strategy dinners with top founders, and what makes the strategy
where
dinner
it's very clear what the moat is. It's very clear what the unique, thing that this company has that nobody else has is, and then we can really talk about leveraging that into the next level and beyond. That's what I love. I love focus. I'm very open to, and a lot of people can say this, but I don't think they're good at it. Like, I think at Founders Fund, we are simply just really good at being open to the fact that there are multiple different strengths, moats, uniqueness, things about people that other people can't see. A lot of firms are looking for tracked founders, or like, they have a good sense of what they're looking for. I'm like, I have no idea what I'm looking for. Surprise me with something that is truly unique, and I'm in, right? Regardless of what it is. And so I love that. When you're dealing with a company, a founder and a company that know what their strengths are and are very honest about what their weaknesses are, and we can talk about leveraging the strengths of the company into a much more dominant situation. That is strategy gaming 101. And that's what I love.
Can I ask, have you ever thought there was a moat and actually you overemphasized it, thought it was stronger than it was, and it didn't pan out the way you thought it was? Of course.
Yeah. Like, you're not going for, this is such a generic thing to say, but you're not going for like having all, no way in venture, especially when you do these like massive bets, are you going to have every single one of these be right, nor do you need that, right? You're trying to maximize your upside. You're not trying to minimize your downside. This is why I've never understood these like, oh, we're going to do a round with 3x participating preferred and a round with a whole bunch of structure. I mean, like, I get that if I'm a debt guy or I'm a bank guy, like, yeah, that's exactly what you want. If I'm a upside venture guy, it's like, that's just totally irrelevant. Like, what do I care if I like get 2x my money back in a downside scenario? It's like the same thing as going into zero. And so I just maximize only for upside. And so of course I'm going to be wrong. I'm wrong all the time. It's, I've always said, this is what I say to founders too, right? There's never somebody who needs perfect information before making a decision is going to be terrible at this job. You never have perfect information in this job, ever. If you need it in order to do a deal, don't do this job. And so because of that, you're going to be wrong. So all you can really do is follow your gut, whether you're me or whether you're a founder. And then when you are wrong, not if, but when you are wrong, you refine your gut. You're like, what happened there? Okay, well, probably won't fall into that same trap another time, right? For instance, for me, meeting a founder in person is just critical. I was terrible at this job during COVID, right? Like when you couldn't meet founders in person, I'm just terrible at this job without being able to meet founders in person. And so I needed to not do a lot of investing when the only way you could meet founders was over Zoom. Now that that's over, and now that people are meeting back in person, great. This job is, I can do this job again. But that's kind of a recognition of, what you're good at, honing your skills, realizing something went wrong, and not trying to make the same mistake twice. But still trusting yourself and trusting your gut enough, because you are never going to have perfect information. And if you get shell-shocked in this business, you're not going to be successful because you'll never make an upside investment. There's going to be hair on every single deal, right? Like there's never is any deal going to be perfect.
I totally agree with you. You said there about kind of the importance of upside and how actually if you get 1x back, but 0.5x back, it doesn't make a difference.
I don't really care if I get 1x back, 2x back, 3x back on a specific on a company. I care about getting, multiples of a fund back. I don't there's no difference between honestly, our funds are multi-billion dollars, right? Like if we have a $10 million check, there's no real difference between that going to zero or that going to 30 million. There's just no difference between those numbers.
Does that not make it, given the size of your fund state, does that not make it incredibly hard? You can do $100 million check.
It makes it incredibly hard. If I'm talking to new managers, the advice that I always give them is, and this is counterintuitive, but it's the right answer, raise as small of a fund as you can in order to just crush it, because then you can write your ticket for a number of funds. It is much harder to get returns on larger funds than it is on smaller funds. It just is. And so, until you really, I would say until you know that you can write a 30%, 25 to 30% of fund size check, raise whatever fund size you can in order to be comfortable writing a 25 to 30% of fund size check, right? Like if you're not comfortable writing a more than a $5 million check, do not raise more than a $25 million fund. Just go crush a $25 million fund, right? And maybe raise more frequently. For me, this fund size is important because remember what I do. Where I'm best is at writing these $200, $300, $400 million checks. And so, if I'm using my own, practicing what I preach, it's like if I'm comfortable writing let's say the biggest check I'm comfortable writing is a $500 million check, which, it's probably roughly that, then I should raise a $2.5 billion fund. But not many people can say that they're truly comfortable writing a $500 million check in venture.
Sorry, I sound really immature and naive here, but $500 million, it's a lot of money. Do you go, when you are writing that check? Do you feel?
I wish I'd written 500. I wish we had written a $500 million check into Airbnb at the $1.5 billion round instead of a $150 million check. Again, you're gonna put the most money possible into the best companies possible at the best price possible. That's venture capital. There's nothing else in it. There's no have a bunch of Monday morning partner meetings in order to be successful. There's no most money in, best companies possible, best price possible.
And loss ratios matter a lot.
Loss ratios don't matter. Losing, I can't, you don't want to lose a $500 million check, right? Because it's going to be then ridiculously hard for you to return multiples on that fund. Whereas if in a fund that size, if you lose a $5 million check, it doesn't really matter at all. But no, you don't want to lose a $500 million check. And that's why I reserved those for, I wrote a $200 million check into Anduril this year because, Anduril is going to be an extremely valuable company. Quite sure of that. We are not going to lose that $200 million check. That $200 million will turn into, $2 billion.
Have you always been this style of investing, Brian?
That's the only way of investing that I know how to do. And I think it's one of my unique moats and unique angles is that I'm good at this type of investing. And I'm honest with myself on what I'm good at and what I am not good at. And I'm good at this kind of stuff, and I'm not good at other things in this space, which is why we try and partner with people who are totally different from us, right? Like, I don't know how to start a company. Great. Do I love having Keith and Trey as partners? 100%, right? They're great at it. I don't know how to do financial analysis on companies. Do I love having Napoleon as a partner? Absolutely. I know nothing about macro, right? Do I love having Peter Thiel as a partner? Absolutely, right? I mean, you don't try and hire clones of yourself. You try and work with people who have their own unique strengths that are the best in the world at something.
Is there any partner set where you feel you're missing that skill set? You mentioned there the financial analysis with Napoleon. You mentioned the macro with Peter. Are there any way you're like, we really miss a sales?
Oh, I'm sure. Well, look, I didn't know what we were missing. Like, I didn't know how much we were missing as Sam until we met Sam. But I'm just very open to there being, somebody who's really good at something that I never even considered. Both on the this is the same thing that I do on the company side is on the team side, right? I'm looking for companies that have a unique mode. I'm open to anything. I'm the most sector agnostic person you can possibly imagine. And I'm open to any company that has a unique moat in a huge market run by a great founder. I'm open to hiring anybody at Founders Fund that has a truly unique angle that I didn't even necessarily know I was looking for. So when you ask me a specific, are there like a specific hole? I'm sure there's an infinite number of holes that we have at Founders Fund, right? Like, and I'm open to, seeing whatever they are, right? I didn't know we had a hole until we met Sam, and then I realized, oh man, this is going to fit a huge hole.
You know what I find really hard about hiring and pre-seed investing in particular is trust. And trust, I think, is built over time in many interactions, in many different situations. And both with pre-seed and with hiring, you're often thrown a meeting and, hi, Brian, lovely to meet you. I can sell really well. Believe it or not, I'm good at marketing myself. But that may not be true. We both know people, who may not be as good as they seem or much better than they seem. How do you think about that? Because I find that really hard and I don't have an answer for that.
Oh, I mean, you don't just you have multiple conversations with people. Like, backchanneling is still important. And I like the type of backchanneling that I like is where they can't tell what you want to hear, right? It's quite easy to backchannel and due diligence on something when the human being that you're doing diligence with kind of knows what you want to hear, and they're just inclined to tell you what you want to hear because no downside to them, right? So the stuff that I like the best is when you ask questions that the other person doesn't know what the answer should be, and so or what you're looking for. And so that's how we kind of backchannel all of these candidates to try and figure out is Sam truly an expert at, high growth tech enterprise sales, right? And so we try and figure that out. And of course, we've been wrong sometimes on that front too, but that's okay, right? We're really good at adapt or die. We don't just sit there and be like, oh, we made a mistake, so let's never do this again.
Have you made mistakes on hiring?
Of course. I made a mistake, on investing, on hiring. That's the same thing to me, right? Like, everything. I make tons of mistakes. Again, you do not have perfect information in this business. If you are the type of person that is going to do work, and make sure it's perfect before you invest or make sure it's perfect before you hire, you are just not going to do well in this business, period.
How do you advise your younger members of the team who saw their books last year blown up and they thought they were fantastic investors, and now everyone's looking a little bit less confident? As a patriarchal leader, how do you sit them down? And
we have had this conversation. This has happened with many emerging teams. It's like, if you get shell shocked in this business, you want a little bit of shell shock because you don't want to just deploy capital willy-nilly. But if you get so shell shocked that you can't do another deal, you're not going to last either. So we see anybody we hire, anybody that comes on board here, we see something, and they know what this is. Usually, this is part of our discussion. Some unique angle that they have, and yeah, maybe stuff is blown up, but you get shell shocked, you may as well leave.
For those that do, like shell shocks, you may as well leave. For those that do work, you've seen partners rise through the ranks very, very efficiently and well. Are there commonalities in what makes them rise through the ranks versus the shell shock that fall?
Yeah, I mean, in this bit again, the investors that are waiting around for pure, perfect information are not going to last. However, so therefore, and there's all this debate. I see a lot of chatter on the internet like, oh, this whole concept of gut in investing is nonsense. I'm like, what are you talking about? Like, when do you ever have perfect information? Like, you can't just like analyze a business plan and know, oh, this is going to work. That's like total nonsense, right? And so the team members that we have, take the punch in the gut from these companies and learn from it and maybe make some refinements on your strategy. But unless you can keep leaning into your strengths, just leave, right? If you're too shell shocked to like leverage, what made you special, then you're just not going to last in this business at all.
Listen, I totally agree with you. I just love the way that you put things so bluntly, Brian. To be honest,
it doesn't. It's to me, it's just we're in a return. Yeah,
it's refreshing. Can I ask, what was your most successful investment ever, Brian, today?
Oh, I don't know. I mean, we've had a bunch of these things. In terms of like returns, tons of stuff. Stemcentrx, Affirm, Airbnb. We'll see what Stripe. I mean, we've had a lot. I mean, and then there's SpaceX, right? And I'm not going to talk about like me personal, but from a founder's fund perspective, we've been fortunate to have a lot of successful investments. And again, just as part of we don't have hubris about knowing the public markets better than anybody else. But the fact that we were able to distribute, end of 2021, when a lot of people kind of held, worked out in our favor this time.
It is interesting, though, because you have this kind of a bit more lone wolf style partner approach internally than most do. But then to the external
because we all have our unique strengths, right? And we trust
but then to the external world, there's no star culture. Do you see what I mean? It's interesting.
Yeah, I mean, I try and my life strategy is to maximize my dollars to fame ratio. Like, I want to make a lot of returns for myself and LPs and have the minimal amount of fame possible, right? Like, you have to do some things to kind of get your name out there, and I get it but we don't have like a need to be the star thing. I just want to make the returns.
I thought you just liked talking to me, Brian. Now I'm hurt. Listen, I totally get you. Someone once told me you want to be the most famous person in the private jet center, and no one know you in McDonald's, and I thought that was well put.
But I guess it's one way of looking at it, yeah.
But I want to move into a quick fire round, Brian. So I say a short statement, and you give me your immediate thoughts. Does that sound okay?
Sure.
Ready? Okay, so what's your biggest strength, and what's your biggest weakness?
My biggest strength is I am truly open to anything. I have no dogmas about how the world should be, how the world will be, how the world is. I'm open to unique angles of any type.
And weakness?
I mean, I guess it's a weakness. I don't put skill points into things that I know that I am weak at, which could, be kind of a strength, but it's also a weakness in that I remain weak at what I'm weak at for very, very, very long periods of time. Maybe that's more of a life weakness than it is a
strategic
job
choice.
Weakness, but it's a life weakness, right? Because there's always things in life where you kind of need to get better at them, where you are weak, that you can't just hire a team member to supplement, and I just remain weak at those things, and that's a weakness.
Did becoming a father impact your mindset, investing?
Sure.
Or how so?
Two things, right? I used to be able to do this job with, every night I was having dinner with a different founder, or I was, doing stuff at odd hours and doing all kinds of stuff, right? And now, post having 2 kids, that's just a lot harder. So I guess there's the mindset and then there's the physical. And, I'm with my kids for dinner every night, right? Like, and so it's harder and harder to do strategy dinners with founders. And in terms of a mindset of knowing that I need to get better, at certain things that I'm not good at, well, you need to do that with your kids, right? Because, you don't want to, there's lots of things you can outsource in life, but child raising is not something you want to entirely outsource, right? Like you want to spend time with your kids, and I do. And so I suck at a lot of those things, and needing to get better at those things is hard for somebody who's always put skill points into things they were already good at.
Who's the best board member you've sat on a board with, and why?
Usually the best board members, not necessarily investors, right? But the best board members are ones who really know the sector that the company is and know people in that sector really well, such that they can easily connect said company with other people that might be relevant to them, right? Like, that's not the same as the best strategizer, right? These people could be very stale on strategy, but they're the best, best board members. You do want board members who are good at governance, Rolodex, financials, right? That's not me. And so, the best board members I've seen are ones where it's like they're just so good at that specific company, that. And I don't think there's any investor per se, right? I think that the best board members are like the specific ones, the outside ones that you find that really are truly door openers for your company.
Totally get you. Who's the person that when they send you a deal, you jump on it? You're like, oh shit.
Harry Stebbings.
Now you're a charmer, Brian. That is
no. I try and make sure that my network is all, like, when somebody who I think is talented sends me a company, highest priority to do that meeting. Just because, again, the part of this, I think if venture capitalists see the right deals, pick the right deals, get into the right deals, I'm not too worried about my picking and getting in skills, and I'm very worried about my seeing skills, especially as I get older and my networks get more stale. So for people who send me stuff that I think are awesome, I'll take that meeting.
I totally get you. Tell me, final one. You mentioned it before, but Anduril, what in the moat in particular? I'm intrigued. You mentioned moats a lot. What got you the confidence that Anduril's moat was just so compelling that you wanted to put 200 million in?
I don't even know where to begin on that. We put 400 million in that company total now. This is just our most recent one was 200 million. This is an example of cross fund. I don't think any of our investors are upset about the fact that Anduril is in multiple funds, but. And the moats are extensive on Anduril, right? Like they are in a space that hasn't had true new tech, entrepreneurship in decades, right? Your most valuable companies in the space are Lockheed, Boeing, Raytheon. These are companies that have been doing cost plus models in defense forever, and have had no real true, ingenuity. You take the Anduril team. The team a team who is seasoned, who knows what they are doing, has great government relations, pair it with a person as brilliant as Palmer Luckey in terms of product, tech and product brilliance, to be quite frank, right? And you've got something truly special. Pair it with a space that until recently was considered, oh, you can't do that in Silicon Valley. Now it's not, post, Ukraine and post a couple of other things. But before it was like, oh, you can't work on defense. That's not a proper thing to work on. You should work on chat instead. And so you take a team that has the culture of working on things that nobody else was willing to work on, with a top tier tech, top tier product, top tier government relations, and top tier execution team. There's nothing like that. Period. I mean, we've seen a ton of defense tech is an area that I'm bullish on, but there's nothing like Anduril. It's just there's no other team like Anduril because they came around, they came together at a time where you just couldn't. Nobody else could possibly pull off what they were doing, so they got the best people who wanted to do that.
Brian, I absolutely love our chats always. I can't thank you enough for being so entertaining and for also answering my very prying questions. I really appreciate it as always, so thank you.
No problem, Harry. Thank you.